Good afternoon, everyone, or welcome to our live webinar of Advanced Insights into Share-Based Payment Taxation. It is my pleasure to introduce our speaker, CA Darshak Shahaji. Shri Darshak Shahaji is a chartered accountant by profession with
Good afternoon, everyone.
with a key
Welcome
focus.
to our live webinar of Advanced Insights into Share-Based Payment Taxation.
Shri Darshak Shahaji, chartered accountant by profession with a key focus on corporate tax advisory and business automation and analytics. He is a partner at SN and Company. He is a member of the International Taxation Board, BCAS, and invited as a speaker by esteemed. So I request you, sir, to start your webinar.
Sure. Thank you. Thank you for the introduction, and I'm sure there are going to be a lot of new viewers who are going to listen to this webinar. I'm seeing some background, so can you please do some technical changes? Hello? Yeah, I think now it's better.
Yes.
Now, so the today's objective of this webinar is mainly to ensure that there are a lot of new things which are going around in terms of ESOPs, in terms of CSOPs, phantom shares. So what are all these things? So we'll be discussing about it. We'll be also discussing about what are going to be the treatments when it comes to accounts and when it comes to taxation. What are going to be the treatments for that? So we are going to discuss that. Interestingly, because these are new concepts. So CSOPs is basically a concept which works into this startup world. Phantoms is also very prominent as far as startup world is concerned. Stock appreciations and ESOPs, of course, we all are broadly aware about, and sweat equity. So that's broadly the terms which we have been aware about. But the new concept is CSOPs, MSOP, uh, TSOPs. So these are all the community-based stock options, which plays a very new role when it comes to the startup world. We'll also be discussing about some of the case studies which are very important because nowadays a lot of foreign employees are getting the shares of Indian company. Maybe because previously they were in India and now they have migrated to overseas, and therefore now the shares are getting vested or exercised by the foreign employees and they are getting the new shares. Now, what should be the tax treatment in relation to that, and vice versa, where the people who were there in foreign countries got ESOPs, now they have become resident in India, and therefore there can be a change in the tax treatment, which becomes important. So that's also one of the element which we are going to discuss it today. So I'm sure this presentations is going to be very relevant in terms of the practical practices which people have been doing across. With this, I'll be starting this presentation. I'll just give you a very brief about what are the important points which needs to be looked into or kept in mind in terms of each of the instruments. So when we talk about ESOPs, basically it is for employees and directors, not available for independent directors, not available for the employees who are from the promoters group. Mainly the objective is that the promoters group, if they already hold certain shares, the share does not get increased by giving ESOPs. So therefore, there are certain restrictions on that. When it comes to sweat equity, basically sweat equity is available for employees, directors, and people who are joining the organizations and being there within organizations for more than a year. So these are the people who get this privilege to get sweat equity. Sweat equity is a concept which people have been or the companies are adopting mainly to get somebody on board, to give them confidence that yes, we are ready to dilute the equity and hire your expertise to the organization's growth. So that's where the sweat equity plays a role. A locking period, largely ESOPs does not have any locking period unless it is specifically mentioned. Whereas sweat equity, as per the company's rule, there is a locking period of 3 years. Uh, that's mainly because once the set equity is being granted, it should not so happen that it becomes a traded stock for the company or for the person who is getting the sweat equity. Therefore, there is a lock-in period. Valuations at the exercise price and at the grant time. So when you are granting ESOPs, there's a valuation which is to be carried out, and while you are exercising it, mainly from the purpose of calculating the taxation, the valuations are being carried out. When it comes to sweat equity, it's basically valuations are being done mainly based on the intellectual things which so basically what are the intellectuals which we are hiring, that plays a very important role. Valuations of shares, basically I've just mentioned on the screen who does the valuation, and the screen is absolutely available, so people can look into it so that we can go on to the important element of tax of the issues evolving around ESOPs, CSOPs, etc. When we go to the restrictions, in case of sweat equity, there is a restrictions where it says 15% of the paid up capital. That's something which is one criteria. Or the second criteria is 5 crore rupees. The overall limit cannot exceed 25%. So that's one thing which needs to be kept in mind. So however, this particular criteria is not applicable for the startup companies who are eligible startups, wherein they can go for sweat equity to the extent of 50%. So that an open window is available for startup eligible startups where they can extend themselves by giving sweat equity to the extent of 50%. However, others have a restriction of 15% of existing paid up capital. So if the shareholder already, if there is a shareholder, then basically 15% of existing paid up capital and not above 5 crore, or at an overall level, it should not be more than 25%. So that's the point. Taxation, we all are aware of, it is at an, ESOPs are taxed at an exercise time. Just give me 1 second, I'll just adjust the screen. Yes. The concept of community stock option. Now, what is this concept? This is not a very new concept. This has been there at least. If people are talking about it, and therefore everybody who are into the consulting background or people who are into advisory background or in practice, people should be aware about what this concept is. The concept is basically a form of a commitment, okay, where a startup, let's say an organization which is trying to raise the funds, but there's a community who wants to invest into the startup, but they want to invest into piecemeal. They don't want to invest into a larger chunk of money. Now, what happens is this we can say, not exactly, but just to make a reference point, I'm saying that it becomes like a crowdfunding, right? Wherein there are multiple people all across who are funding this particular company, and the company is then using this money to do the business. Now that's a similar concept as a reference point. But yes, what it does is there's a community who are ready to invest into this particular business, and all wants to invest in a piecemeal. Now let's say if this option is not available, then what would have happened? What would have happened is everybody would have got the shares. So there is one share to somebody, one share to somebody else, one share to third party, etc., etc. Now in order to avoid this particular admin or differentiating of multiple shareholders, what this pool would do is that basically there's going to be a pool under which there are certain number of shares which are designated, and this particular pool will give the shares to independent shareholders who will be contributing to the company. And there is going to be an agreement which is going to be there. That agreement is going to be specifically describing about the terms and conditions what are getting agreed between the company and the community, right? So that's the kind of arrangement which we are talking about under community stock options. Now let's understand what are the advantages and disadvantages. Of course they are there on the screen for you to view, but I'll be elaborating it so that it makes clear. The point one is efficient standard agreement. So largely, if this agreement is there, then if in the community, let's say there are 100 subscriber, there are 1,000 subscriber, all will be communicated, and therefore there will be a standard agreement which will be agreed by all the parties. Startups would not be having problem because they could be in a way, but to say could be a crowdfunding raising exercise which can happen over here through which the money can be contributed. This can be at the initial stage when the startup has an idea and they want to evaluate, they want to actually work on an idea, and they need a funds to work on that particular idea, and that's where this kind of a instrument can be worked upon. Financial protection, basically because there is an agreement which is agreed between two parties. That agreement plays a role of financial protection. Of course there is no regulations who can play a role into it, except to the extent of the agreement which is agreed about, a contract which is agreed between two parties. So that's something which is there as a part of the document. It's a direct investment into the company, so all of them is going to be contributing to the company directly. So that's not going to be a separate entity where they are going to contribute it. They are going to contribute into directly to the company. Information rights. So of course, because you are participating into the shareholding directly, therefore you will be getting some information rights against that. So that's one important element. About the company, you would be able to get the informations which you have agreed into the agreement. Disadvantages, of course, it is not going to be a part of your capital table. That's one thing. Mandatory call options. So in case if you still want to continue to the hold, whatever you have agreed in the agreement, right, that is going to prevail. So if that is something which it talks about a certain value at which you need to take an exit, then yes, that is going to prevail. Or if a particular duration in which you need to take an exit, then that will prevail, as I said. So that's how it is going to function. And therefore there is a mandatory call options into this. No voting rights as you are not a part of cap table. And the other important element is GST. So we'll be discussing this little elaborately as to what is happening currently. Now, of course, as a company, we all are aware of, we are not allowed to take crowdfunding individual from the individuals into the companies, because that's not something which is allowed under the company law. You can't raise the fund accordingly. So what happens is this gets an element of a revenue nature, wherein basically the money is coming by way of a revenue. Therefore, the question arises is that in case if this is a revenue, then what about GST? So there have been many startups who have taken this decision that though there is a GST which needs to be applied, but since though we charge GST, but since this is going to get an additional valuation for the shareholder, which is much beyond 18% GST, which is a cost, right? There is a understanding between the shareholder and the company that though we charge GST as a company to the shareholders and shareholder does not get a credit of that, but that gets compensated against the multiple times value which a shareholder earns out of it. So therefore, this particular instrument is practically working because otherwise 18% GST is an additional cost to the shareholder. Now, the question would arise that what in case if that's a loss? So that's a commercial call which the shareholders have been taking. But since the amount are not very significant, therefore, so therefore, just give me 1 second. So I think the group is saying that they are not able to view the slides which are moving. So I'll just join to this particular presentation by resharing the file. Just give me 1 second. Yes. So we were talking about community plan. I hope people have been able to see the screen. In case if the organizers are not able to see the screen moving, please let me know so that I can again reshare the file. Uh, yeah, we were talking about GST. So that's a commercial call shareholders have been taking because they are seeing that, okay, because of this option, they are able to earn multiple revenue out of this. Now, multiple valuation. So since the multiple valuation is higher, they are offsetting against the loss of GST credit. So that's something which is working currently in practice. Yeah. Now, these are some of the points which are related to CSOPs. CSOPs are basically the concept wise, it is community based stock option, right? Now there can be many other things like it can be MSOP. MSOP is basically merchandise stock option. It can be TSOPs. T means teacher. So if there is a community of teachers who wants to contribute for certain concepts which is for education purpose and startups are growing into that side, then there can be a community of teachers who can come together and contribute it. So it can be a TSOPs and so forth. So now you can imagine and you can apply your experts ideas to make different communities over here and help startups to grow by raising funds. So this is an initial funding instrument which is there. So that's what we spoke about. Now I am taking you to the next point, which is going to be about phantom shares. Now, this is also an instrument which is running across where initially, or maybe not initially, even for an existing companies. Now, if they don't want to issue shares, okay, but they want to give some commitment so that as the company grows, let's say consultant like us. Now, let's say if I'm a consultant now, and if I'm helping a company to grow into the business, like now in case if I want to do that, okay, in that situation as the company grows, either I should be getting the shares. That's option number one. So either it's a sweat equity which I should be getting, right? Or I should be getting phantom shares. Now, if I'm an employee of the organizations or if I'm getting committed with an employment of the organizations, then I can get sweat equity. Second could be that I don't want to dilute my shares, but I want to be ready, committed to you. So in that particular case, what the company will do, they will give me a phantom shares. Now, as a part of the phantom shares, what I am allowed is that anything tomorrow, when there's a dilution happening, let's say out of 100 shares as an example, let's say there is a 20% dilution and that dilution is happening at, let's say, 400 rupees per share. Now, whatever is the incremental revenue which the company could get as a against the valuation, whatever is the commitment which company or the shareholder or the promoter has given to me as a consultant, that much proportion will come to me. Okay, so that's an additional revenue which will come to me against the services which I have given for which the company had committed to. Right. So that's the instrument which works currently mainly for compensating the consultants. Now, all these instruments, why they have got popularity, one of the core reason behind that, the base reason behind that is because this does not require an outflow of cash at year one, right? So, if let's say if somebody wants to contribute to the growth story of a company, but the company is not able to give cash flow at the first end, in that particular case, these instruments are playing a role, right? So as we are speaking, just see let's see the differentiation between sweat equity and phantom. Why I have given specifically a differentiation between sweat equity and phantom is because in both these instrument, what is happening is I am not giving a particular document or particular shares like sweat equity. When I'm giving sweat equity, basically I'm getting committed. When I'm giving phantom, I'm getting committed. But when I'm giving ESOPs, okay, what happens is you grant ESOPs, then there are certain conditions. If the conditions are satisfied, then you get vesting. So your commitment starts from the day when your conditions are getting satisfied. Whereas when it comes to sweat equity, basically you're applying the sweat equity so that the person is getting confidence into your business and it becomes part of your growth story. Phantom is also in the same manner, only difference is that the shares are not getting issued. So as you are saying in the first point itself, what it says is there is a direct allotment in sweat equity. Of course, there's a lock-in period for 3 years as per the company's law where you need to lock yourself so that you don't dilute immediately by getting the shares. Second is phantom shares. So, okay, before going on to that, let me give you one case study which I had come across. So there was one organization where the director was asking for ESOPs. Now, what happened is company gave ESOPs to that particular director, and the director, after getting the ESOPs, he left the organization. Right? There was no commitment which was agreed by that particular company with the director for locking, and because of which that person left the organization. In such situation, what happens is the director, after getting the ESOPs, if he leave the organization, in that particular case, he is getting the benefit for the future growth of the company where he is not contributing. Now, that's something which is a disadvantage from the company's point of view because company is giving ESOPs mainly because they want that the director contributes more than what he has been contributing, and there's an ownership flavor which is coming across. But that's something which left this company behind because the director left the organization. Now, in such situations, there's a lock-in period. In sweat equity, there is a lock-in period of 3 years. So you cannot sell the shares for the period of 3 years. As far as Phantom is concerned, there is no dilution of equity as we spoke. On exercise, basically whatever shares are there is issued to the employee at a discounted price, which is allowed under the company's law. So you can give it at a discount because there is some IPR, some intellectual which a person has been contributing or bringing into the growth of the company. Therefore, that is something which is allowed. Compensation given. So here what happens is if suppose you have been getting the compensation, uh, so that's mainly from the appreciation perspective. So what happens is you are getting commitment. Now, after the commitment, whatever appreciation is happening, you are eligible for for that appreciation which the company is gaining from the growth story, and you are eligible for that. Cash flow, as I said, there is no cash flow initial, no cash outflow. Who gets what? So basically, sweats are generally for employees and directors against against the contribution which the company is getting from the person who is getting sweat. So that's the barter which is happening. When it comes to phantom, that can be given to vendors or consultants, right? So they can be eligible to get this particular benefit. And this can be an instrument to barter in certain situations where the cash outflow is a problem, but both consultants and vendors are able to see the potential of the company and therefore they get ready to commercially barter with you. In that case, these phantoms can play a role. Impact on financials, yes, P&L impact as far as sweat is concerned, it is basically at an FMV value uh, in the year of allotment, because that's the time where company is obliged to book the liability, and therefore that is the time when it is going to be hitting to the P&L as a employee compensation. When it comes to phantom is basically when it is getting the when the liability is getting discharged, right? So every year, let's say if suppose you have got the commitment, okay, and it's not a conditional based commitment, okay, it's a agreed commitment that yes, this is something which we are agreeing and locking. Now when you have locked, that means the company is now under the obligation to do that. Now the year on year, when there is an incremental incremental value of the commitment, therefore that has to be booked as an expense as a under the provisional account. So that's something which is actually the a hit to the profit and loss account that needs to be looked into or taken care of. When it comes to taxation, sweat is of course at an allotment. When it comes to phantom, basically, of course, this is a debatable issue as to when is it going to be taxable, because the taxation could be at the time when I'm accruing that particular income, or it could be accruing when the it could be taxable in the time when the money is actually received. Now, that's a concept which, of course, is something which we all have been discussing many times in many of the discussions, where what is the time when I'm accruing an income? Is it accruing at the time when the company is booking it as a provision, or it is at a time when basically I am actually receiving the income under the real income theory? So this concept of real income theory under against the provisional on the conservative basis. Now that concept everybody have been aware about this particular debatable matter, and therefore that is something where I'm not going too detailed. But yes, that's a fine. That's a call which one has to take, and whether they want to be aggressive or they want to be conservative on this particular aspect as far as discharging the tax liability is concerned. In terms of valuation, it is fair market value, and as far as phantom is concerned, it's a differential value, of course, because what I'm going to get is the differential value. So if I have got lock myself at 100 rupees, from 100 rupees, whatever is the appreciation which I'm eligible to, I'm going to get the benefit of that, right? So that's the differential value, which is of course going to be taxable in the hands of either a vendor, consultant, or whoever is eligible for phantom shares. So that's all about differentiation between sweat equity and phantom shares, right? Let's move forward. Moving to the next point. Now, this is one of the important slide of the presentation. I'm sure people who have been there online, not being busy with some other things and trying to be participating in this particular webinar, this is one slide which they should be looking into, and they should be viewing it, because they will be able to have the crux of the whole presentation, right? Something which I have been discussing is what I have briefed it over here. Very quickly, I'll take you to the important elements of it. ESOPs, it's a conditional. It can be a conditional allotment where after certain achievements of by the employee, they will be getting the ESOPs. That could be one thing. It is basically on exercise, so option gets converted into equity on future dates. Cash flow, no cash outflow. Uh, Issued to employees or director to retain them or to get more contribution as an ownership flavor. That's one reason. Impact to financial is basically impact to profit and loss during vesting period. So the moment the equities are getting vested, the impact it gets proportionately uh, uh, cost to the P&L account, and that's basically differential between the grant value. So whatever is the grant value minus exercise price, because that's something which is tangibly visible. So that's going to be the proportion on the proportionate basis. It is going to be charged to the P&L account. Taxation wise is of course on the exercise time, and valuation is the exercise price, right? So that's about ESOPs. When we go to sweat equity, we have already discussed. So I'm not going to take that now again, because that's the previous slide where we have discussed this. When it comes to stock appreciation rights, there's no equity dilution, because there what happens is you are getting a right into the company, and so whatever appreciation are happening, proportionately you are getting the benefit of that. Compensation is given to employee on the appreciation. So any price, largely this happens with the listed organization, because every time there's a transparent availability of the price on the exchange. So therefore we are able to correlate it, and therefore this is very much uh, subscribed or applied or used by the listed organizations, mostly used by listed companies, since fair market value is readily available, can be used to pay employees, right? Impact to PNL each reporting year until the liability is discharged. So till that time, on a provisional basis, it is going to be booked to PNL account or charged to PNL account. Taxation is on receipt basis, of course, and taxation on differential value. That's something which can be convincingly agreed upon. Phantom shares is basically, we have already discussed, so I'm not going to go again into the discussion of that. Now we go to the next point, which is basically the share price. So CSOPs. So CSOPs, again, basically there is no allotment of shares. There's a commitment which happens. Exercise is basically the moment you enter into an agreement, you are getting committed. A company makes a commitment, and there is an agreement which is agreed to discharge in future terms. Cash flow, no initial cash flow, but yes, the company would be getting the money against this particular commitment. Issued to whom? So basically used at which level and how. So now that as we spoke, community, different communities would come together and would contribute to the growth story, and therefore that's how this particular impact is there. What will be the impact to financials? So basically, when it comes to CSOPs, okay, what is important is that how your agreement is crafted. I'm not saying drafted, I'm saying crafted. So basically, how the agreement is crafted plays a very important role, because that would signify what should be your accounting treatment and what are the obligations which you are taking at what levels. So, depending upon the kind of obligations which has been agreed upon in the agreement, that's how the treatment will be considered. Just to give you an example, if suppose I am getting committed that yes, on the day one, my commitment, like in Phantom, we have agreed that okay, whatever is the appreciation will be something which we will be giving it back to the community. So I'm talking, when community, I mean this specific community who have subscribed for it. So that community. So therefore, in that case, company has taken the obligation, and therefore they have to discharge that particular obligation, right? And therefore they will have to consider it. But then, of course, there are a lot of ways in which it gets crafted. Taxation, how will it be taxed? In the hands of subscriber and the company. Now, when the money is received, currently what is happening, since there is no proper regulations for this, so no specific regulations which are available for this, and therefore, what happens is currently it is not considered. Sorry, currently it is. There's no absolute clarity about how it should be treated, but currently in practice, the way it is getting treated is, it is considered, when the money is received by the company, it is considered as revenue. And when the money is paying back, the question arises is whether this will be allowed as an expense. Because I got a money, let's say somebody, as a community, out of one of the whole community, there is somebody who have contributed 5 lakh rupees. Now 5 lakh rupees, when it is received in my account, it's a revenue for you. Okay. Now when I'm giving him back, let's say 5 lakh 20,000 or maybe 7 lakh rupees to that particular person, that additional amount is going to that particular person. Now, whether that is going to be allowed as an expenses to me into my accounts, that's something which currently the industry is dealing with, because there is no clear guidelines or clear availability of clarified a point on this, that okay, whether that will be allowed as an expenses or not, and whether the additional contribution will be allowed or not. But what is happening is, we are talking from the tax perspective, but when we look from the startup world perspective, when that particular idea, I'm giving you a different dimension, because everything cannot be only judge based on the taxation, right? That's very important. So what startups are doing is, because they have an idea and they want to work on that particular idea for which they need fund. Now, a particular fund is not directly contributing to it because they are at the initial stage of the startups, and therefore, what happens is a community is coming together and they are getting ready to contribute. Now, the startup is not going to look from the taxation perspective, right? They are going to their whole objective or their need today is basically to raise funds so that they can work on this particular idea, and therefore they are taking this additional aggressive call that yes, we need to go ahead because we need this fund so that we can commercialize and we can actually work on that particular project. Therefore this particular instrument is working. I can appreciate, I can understand that yes, from the consulting perspective, might be we would have been very clear because there is unclear pathway right now. As a consulting, maybe we could have not advised this to the client. But when we look from the practical sense, where the startup is actually looking out for working on that idea and they need funds, then they look from the commercial perspective. They don't look from the taxation perspective. That's something which I want to bring it out, and therefore this instrument is actually working. Is what I want to bring. I want to put it on table. Yeah. Valuation. What will be the valuation on redemption at redemption? That's what I was speaking about. That let's say against 5 lakh of rupees, if the person is getting 7 lakh of rupees against 5 lakh. Now, whether what is going to be the taxation part of it? Whether 7 lakh is going to be taxable to the employee, the answer should be that seven full amount should be taxable, or seven minus five what was contributed should be taxable. Whether in the hands of company, whether 7 lakh will be allowed as a deduction, the answer is that 7 lakh whether should be allowed or not allowed. That's a point. So 5 lakh, if one may say that 5 lakh is a revenue which is considered, so 7 lakh now when it is paid back, it should be considered as an expenses. But one may also say that it is a capital cost, so that should not be allowed. So that's kind of a debate which of course is there between the community right now. But as I said, startups is indifferent as far as they need to raise the funds. Yeah, when they don't have an alternative, they have been doing this particular thing. Yeah. In case if there is any specific question, of course, Tax Guru is obviously there to guide us in terms of what individually the should be done. So of course, people, the subscriber can raise questions on the email communications to Tax Guru, and Tax Guru, of course, will then reach out to the right panelist and then come back to you. That's something which can be worked upon. I am also obliged to share my email ID. This is there at the bottom of the presentation on every slide. In case if anybody wants to touch base, then of course they can touch base directly. Moving on to the next point, what is trust root? So now when we go on to the trust root, what happens? So I'm sure everybody are aware of that there are trust roots are also some important thing. So it's also an important way where the companies are actually raising ESOPs, right? So how does this function? So this is a chart. This is a chart which is commonly available. So that's nothing something which I have developed. It's something which is commonly available. I'm just using this chart as a reference point so that I can explain the concept. The concept is, as you are saying, number one, there's a trust. The second is there's a common entity which is a employee welfare trust which is getting created, right? So that's one thing. Now there can be many trusts, okay, because if the schemes want to work individually, okay, there can be two trusts, right? That's possible. So I'm talking about one right now so that we make the point clear. Now that's in trust. Now within that trust, what happens is, let's say there's a scheme which is running for employees. So the scheme will be run under that particular trust. The trust will first raise the funds from the company, right? The money will come into the account. Now, this money will be utilized for the purpose of getting those shares into this particular scheme. I'm not using the word trust, I'm using the word scheme. So the scheme will take funds from the company. They will buy these shares. Okay. Once these shares come in, okay, now these shares are available for operation of ESOP scheme. Now, as the scheme has been drafted, the employees of the organizations will be eligible for that particular scheme, and they will be able to subscribe for it. The moment they subscribe, there is going to be exercise of it. There will be certain money which will be paid to the trust, right, by the employees. So employee will be paying back to the trust, trust will utilize that money to pay off back to the company, because trust has taken this loan at the step one. So they will be using this money to pay off back to the company. So if I summarize it, if you see over here in the slide, number one is to grant loan. So company will give loan to the scheme. Number one. Number two is scheme will buy the shares from the company. Number three is basically employee will basically get the options, right? So there's a grant of options to the employees, which is going to be by the company. Employee will be vesting, sorry, the employees will be exercising that options. While they are exercising the options, they will exercise with the scheme. The employee will be paying money to the scheme, and the money will and the shares will be given by the scheme to the employees, and the scheme will in a way pay back the loan which was taken at the step one by from the company. They will be repaying that particular loan. So that's the whole model in which it works, and that's what I am just bringing it to your notice. Now we go to some important questions, which is FAQ questions, which have come across many times when it comes to us. Now, what are those questions? And we'll deal with these questions. These are very interesting questions, and let me just draw your attention for the viewers that these are the questions which are revolving around today, and it's an interesting questions for us to deal with. Tax implication on the preferential allotment to the consultant. Let's understand this question. The question is saying preferential allotment and to the consultant, right? Now, why we are using preferential allotment to the consultant? Because consultant not being an employee of the organization, he cannot get ESOPs, he cannot get sweat equity, and therefore now he is getting a preferential allotment. And right. Now, when you get a preferential allotment, the point is whether it's what is the tax implication. Now, I'm a consultant, I'm delivering services to the organization against which I'm getting a preferential allotment. Now, when I get this preferential allotment, the question is whether this is going to, what is going to be the tax implication in my hands. Now, this place where if I'm giving a professional services, right, against which I'm getting preferential allotment, then that becomes as a character of professional income form, right? Because I'm getting the allotment against my service which I'm rendering, and therefore that becomes my professional income. Now, if somebody is able to declutter that, okay, I am delivering my service against which I'm getting a particular price, and that is the price at par value against my services which I'm delivering, and this is an additional contribution which I'm getting by way of a preferential allotment. Then, though it is debatable, but somebody would like to take a stand that, yeah, this is something which is against my shares investments and not against the preferential allotment. Though of course the strong argument could be that because the shares are got the shares have been received against the service you have rendered, and you have not paid anything for that, therefore it should be considered as your professional income. Now that's one element which needs to be dealt with when it comes to preferential allotment to the consultant is concerned. So that's one thing. Consultant would say that if it's a professional income, then it's taxable in year one when the allotments are there. And if there is a capital asset in that particular case, though you are receiving in year one, uh, basically you are getting it against your other income, but that would be a difficult stand. But yeah, because somebody is having uh, some other benefits against it, maybe they can take it. But largely what I would say is that because if you're able to correlate that, yes, this is my service delivery against which I'm receiving the income, in that particular case it can be considered as professional income. Whether TDS is applicable on equity under 194R. Now, 194R generally is referring to any benefit or perquisites which is received over and above uh, your professional income in kind, right? Now, in this case, if we are saying or characterizing this to be a professional income, in that case, this would not be getting covered under 194R. This would be covered under the normal provisions of TDS. But yes, when we look from the debate perspective, then yes, because this is a perquisite which with the professional is received against the professional services. But now, if I am characterizing it under professional income and the TDS has been deducted under 194J on this particular amount, in that particular case, this will become to be a 194J tax deduction amount element and not 194R. And if it is taxed under professional income, then yes, that's something which is already taxed, and therefore department would consider that as professional income. Okay, can the method of valuation be questioned by the AO? So now what happens is, let's say you have booked a professional income of 100 rupees. However, the AO is valuing it to be a higher amount, and therefore the point of fair market value will play a role, because you are getting the shares against certain services which has been rendered, and therefore you would like to argue and point out that okay, against this particular services which I have rendered, I have got the shares. Again, let's say you have, if you would have billed that particular services, you would have billed at 10 lakh of rupees. Now against that 10 lakhs of rupees, you are getting the shares worth of 10 lakhs. Then that is a par game, and therefore there is no ambiguity on it. But let's say if you are getting the shares which is worth of 15 lakh of rupees, so that's an additional amount which you are receiving. Now that additional amount which is received by you, now whether that will be taxed under professional income only, or it is going to be taxed as other income. Now that's something which can be there, but yeah, that depends upon the facts of each case, because how that case will be treated, that needs to be looked to arrive at this particular conclusion. But the question which is there before us right now is, can the method of valuation be questioned by the AO? Then the answer is yes, it can be questioned by the AO, and he can look into that particular thing. Whether ESOP discount is allowable in vesting period. So the point is that I have already vested the shares, and there is a discount which is there. So of course, the grant price minus the exercise price, that's the amount which we are talking about. So that whether is allowable in the vesting period, the answer is yes, it is allowed. There is a Supreme Court decision in the case of Biocon which is saying that yes, because vesting period is already in, and therefore that is allowed as a business expenditure. Whether SAR is taxable as perquisite or capital gain. Now, these are the rights, right, which is granted to the employee. Now, if they have been granted at the time when the person is under employment, then it is going to be considered as perquisite. However, if it is granted something which is subsequent to the employment, or after the termination of employment, and if there is some the incremental revenue which is getting, then how it is going to be taxed? So when the shares are granted when the employment is continuing, in that case it would be considered as perquisite. Mind you, why this is important is because of the also a reason, because there can be non-residents, and therefore DTA would play a role, and it would have a different tax treatment, and therefore also is important to know that whether this particular perquisites which is received by way of rights, whether this will be considered as perquisite under salary, or it would be considered as rights and therefore capital asset under capital gain. So this therefore it becomes important to characterize it in the right way, so that the treatment and the implication happens to be right. To answer over here, basically till the time the employment is own and continuing employment, it is going to be considered as perquisite, and whatever appreciation is happening, it will be considered as a part of perquisite. Let's say employment has got completed, and now the rights is still continuing. In that particular case, the treatment will be that those rights will be recharacterized as capital asset, and then the appreciation of that can be considered as capital gain. Now that's something which of course needs to be reviewed it from facts to facts, but this is something which needs to be gone into the details to understand it. Yeah, but if we take a at a face value, then this could be the treatment which will apply. Whether SAR is allowable every year on appreciation, the answer is yes, because every year there is a provision which is happening, and that is something which is committed to the employees, and therefore it is a certain liability and not an uncertain liability, and therefore that should be allowed as an expenditure. Now, when the next question is taxation in case of valuation capping and discounting capping, whether investment in CSOPs, we are talking about community stock options, allowed as deduction on redemption. So we were talking about 5 lakh against 7 lakhs. So 7 lakhs is what I got back against the investment of 5 lakhs. So the question is whether 5 lakh, which is good, which was invested, okay, whether I'll be getting the deduction or not. Logically, the answer is yes, you should be getting it. But of course, now we need to look into the overall guidelines which are not there today. But in case if logical inferences has been drawn out of it, then yes, that should be allowed as the deduction. Uh, Whether gift tax, I mean to say section 56. So gift tax may be applied in CSOPs holder on allotment of shares, because what is happening is against the investment which was considered as a revenue item, you are getting the shares. So if the shares are getting allotted under the community plan, in that particular case, the question is whether gift tax is going to be applicable. So here, one of the argument could be that no, gift tax should not be applicable. One of the reason is because there is a contribution by the by the community holder, and he is contributing against which he is getting the shares. So ideally, it is not. But as we are discussing, and I'm putting this particular point that yes, there is no since these are new instruments and this is gaining popularity, therefore the clarity is not there. But anyways, based on the practical sense of raising the funds, these people have been using it. Now the question is whether gift tax should be applicable, but the ideal and logical answer should be that it should not be, because there is a contribution which is made as a part of the consideration against which the shares are getting allotted, and there is an agreement which has been agreed upon. So if it is a legitimate overall transactions, then the gift tax should not be applicable. This is very pretty simple as far as taxability is concerned. The main point or the crux point over here is that it is going to be taxable in the hands of employee at the time of allotment of the shares, which is going to be a perquisite for the employee. And when the employee is going to sell the shares, we are talking about ESOPs, employee stock option plan. So under employee stock option plan, what is the tax implication? The tax implication is that it is first tax in the hands of employee at the time of exercise as a perquisite. After this perquisite taxation is applied, if the shares are going to be sold by the employee, then there is going to be capital gain tax, right? Now the question then arises is what is going to be the cost? Now, important point and very important factor which not looked into is basically, let's say if suppose I have got the perquisite, I have received the money, sorry, I have received the shares as an employee. I have paid some exercise value for it. Okay. And now when I'm going to sell into the market, okay, what is going to be the cost? The cost, of course, is going to be that I have paid 20, but what am I paying? Perquisite tax is basically on 100 rupees, which is the fair market value minus 20. So 80 rupees is where I'm paying taxation as a perquisite tax. So therefore, your cost will get accelerated to 100 because you have paid perquisite tax, right? Under section 17. So 100 rupees is going to be your cost, which is your fair market value, and the sale price is going to be your full value of consideration. Difference is going to be taxed as capital gain. Now, interestingly, we have come across a query or a question for opinion on whether if I'm not paying perquisite tax in India, but I'm paying perquisite tax in overseas. So in a foreign country, I'm paying perquisite tax, okay, which is not taxable under section 17 in India. Now, whether that particular amount is going to be taxable, sorry, in that situation. So let me take an example. 20 rupees is the value of exercise price, 100 rupees is the fair market value. So 80 rupees is an additional value, okay, on which I have not paid tax in India, but the tax is paid by the employee in the foreign country because of the DTAA agreements, where the tax is paid by the employee in the foreign country. Now, whether the tax which is paid, perquisite tax, which is paid in foreign country, not taxed, subject to tax under section 17. In that situation, that additional amount which is paid over there, whether that will be allowed uh, to increase my cost in India? Now that's the question which is very interestingly there over here. As of course we I'm bringing this issue to the point mainly because there is something where the answer is not very clearly defined, because what section 49 is saying is that whatever is the perquisite tax which is paid in India, and whatever is the fair market value which is subject to tax under section 17, that is something which is allowed as the cost. So they have not dealt with this situation where if you are paying a tax, okay, in foreign country against the same perquisite value, whether that will be allowed or not, that is something which is not dealt with under directly dealt with under section 49. Of course, the viewers would like to get the answer, clear answer at what it should be, but unfortunately, I also don't have the clear answer about it. We are basically waiting for some guidelines, clarification, or uh, some rulings from the higher courts, which will clarify or settle this particular point. But yes, right now the position is that the space is unclear as to whether I should be able to take fair market value where I have paid perquisite tax in the foreign country. That's something we are right now dealing with. We move on to the next aspect. The next aspect is basically yes, this is the for the startups, eligible startups who have taken requisite approvals. Now, what was happening is employee were getting ESOPs and they were asked to pay tax. Now, employee, because they were not still they were though exercised, but they were not getting value against that, right? Because startups used to have a gestation period. Now, if I have exercised the rights, but I have not sold the shares because that is not liquidable at this point of time, in that case, I was supposed to pay tax, and there was huge amount of taxes because the valuation would used to increase at a very high speed, and therefore there was a representation which was accepted. And now what they are trying to say is that whatever is the total amount, assuming that that would have been taxed in the year in which you have exercised it, what should have been the total tax? So in my example, let's say 40 is your total salary income, just to take as an example. 90 is your perquisite value on ESOPs, that is something which you have exercised. So total amount income in year one when this is exercised is 1 crore 30 lakhs. Now, what would have been the tax? The tax would have been 44 lakhs if we would have calculated it. 44 lakhs would have been taxed, but what is going to be taxed in year one is only going to be the proportionate values, which is 44 lakhs in our example into for 40 lakhs divided by 1 crore 30, because that's something which is taxable income. So the differential amount, which is basically a tax on perquisite, is getting deferred for startups, okay, eligible startups, where the tax is getting deferred for the employees and they are supposed to pay tax subsequently. We'll come on that, when are they supposed to pay. But right now, on this slide, we are trying to bring it out a point that 44 lakh is going to be 5 o'clock. 44 lakhs is going to be the total amount of taxation, out of which 13 lakhs is going to be paid in this year, year one, and balance 30 lakhs, which is on the perquisite value of ESOPs, getting deferred. This benefit is only for the eligible startups. Now, what are the conditions? So there have been some conditions which are prescribed. The conditions are largely trying to say that until employee is getting the benefit of it, or until the employee is leaving the employment, and for a period, if the shares are hold, then in that particular case, you will not be taxed. But beyond that period, or if the shares are getting transferred or there is a termination of employment, then it is going to be taxable, right? And that is the year in which this differential amount of 30 lakhs is going to get for taxed. So that's all about startup employee taxation, employee tax implications. We are going to the next point, which is disclosure for foreign assets. So how are they going to be disclosed? Now, this is the schedule which talks about disclosure. So we need to disclose the foreign assets over here. So for example, if the company employee is getting a share, and that shares, this is just a example for the purpose of discussion, no relevance with any of the employee of any of the company, but just as an example we are taking this point that okay, this is the shares which are getting issued, and this is the price. So X price, these shares are getting issued and exercised at a particular price. So how is the reporting required? And reportings are required to be made in this particular manner, where at the what is going to be the closing value of the ESOPs is going to be described. If there is an opening value of ESOPs, that is required to be disclosed. And if suppose this particular shares are exercised or sold, and if sorry exercised and sold, in that case that is required to be reported as to what is the amount which is received, right? So that's the treatment which we have to bring it out. So if you see over here, what is the closing value of investments, which was 50 lakh of rupees, and what is the value at which it is exercised, which is basically 32 lakh of rupees. So that's something which is required to be reported. And later on, if you're getting selling the shares, then that is required to be reported. Currently, since in this example it is not sold, therefore it is reflected as nil. So this reporting is required to be made in the ITR for an as regards to the ESOPs is concerned. What needs to be reported? ESOPs, when exercise, requires to be reported as to year of exercise. If it is an RSU, then it is the date on which it is transferred. That is where it is supposed to be reported. If it's a dividend income, then basically till the time it is repatriated, that is the amount which is required to be reported. If there's a capital gain, then of course that is going to be reported. So these are the reporting requirements which needs to be reported. This is something where uh, this is another case study which we have dealt with. What happens is nowadays startups basically what let me take this example. Here what happened is there's an Indian company, and Indian companies are getting shares. Sorry, Indian employees are getting rights against the for of the foreign company. So Indian is a subsidiary company. There is a foreign company, and foreign company is issuing ESOPs to the employees of Indian company. Right now, because the value at which the foreign companies are currently there, while they are issuing the ESOPs, it is at a very good value, and therefore employee when they want to exercise it, they don't want to sell the shares. They want to hold the shares. Now the problem is that they don't have that much amount of liquidity to pay off the taxes, right? Now therefore the question is that how the tax gets released to the Indian government, because at the end of the day, since it is exercised, you need to pay off the tax. Now if the employee is allowed to pay the tax, and employer is, which is the company, if they give away the ESOPs, and if the employee does not pay, then that's a non-compliance. So at one hand, employee wants the shares, but they don't want to pay off the taxes because they don't have liquidity and they want to hold the shares. And on the other hand, company wants to give the shares, but company is also wants to ensure that whatever compliance as far as taxation to the Indian government is concerned gets paid off. Right now, in such scenario, what should be done? So one of the outcome which can be worked out over here is that the scheme is worked out in such a way that whatever is the rights which are ESOPs which are getting allotted to the employee, right? In out of that, certain shares should be sold off to get the funds out of that, which is used to pay off the taxes, right? And employee should be clearly should give a no objections at the initial stage, so that the taxes are getting paid off and the shares are given back or are allotted to the balanced number of shares are allotted to the employees. Now, if that is something which is properly documented, then at the time of exercising, the issue may not arise. So this is something where, therefore, I'm bringing it to the notice that at times it so happens that if it is not well documented at the time of exercising, the employee would not agree to it. And if the employee doesn't, because it is not one employee, there are there is a group of employees who are getting ESOPs. Now, if suppose at that time there are some employees who don't agree to it, then the whole scheme cannot work, right? Because if some employees agree, but employees raise the objection, we can't raise the biasness over there. In such situation, there can be a problem. Therefore, this is a suggestion, or it could be worked out that it is well documented at the time of granting itself, that if suppose at that time if the exercise is required but employee is not ready to pay off the taxes, or the tax is more than the salary amount, which is also possible, right? So if the taxes are more than the salary amount, the taxes will be recovered by way of redeeming certain number of shares by the scheme on behalf of employees, and that will be paid off by to the government. So that's something which can be worked out. So I think this is all about which I would like to break. I wanted to bring it out in this 1 hour of presentation. I'm sure there can be a lot more to discuss. This is one group which with all the CA people together. So there are a lot of CAs, approximately 900 CAs who are there, CAs and lawyers who are there in this particular group, who have been chatting across on queries. So somebody would raise the query, and that queries gets answered on this particular group by the community. So people who are interested to participate can participate in this particular group. At the end, I would just thank everybody for giving this opportunity to hear me on ESOPs. I would also like to thank Tax Guru, because they have taken this initiative and chosen this particular topic, and chosen me, of course, for giving this particular presentation. So thank you, all of you. This is where I can be reached upon. My email ID is there in the bottom of the presentation, which is Darshak, DARSHAK @snco.in. So that's where I'm reachable. I leave back this whole floor to the organizers who have arranged this presentation. Thank you very much. Thank you for having a pleasant hearing. Thank you very much. Yes. Over to you back.